All right, guys, I'm going to do a quick video on formatting for Arctic Blast. Okay, so these numbers aren't going to be exactly like yours, but they actually might be kind of close. Okay, so what you'll have, and honestly, this is like a solution for a group. It's not a group in art for this semester. It's a previous one, so it shouldn't be exactly the same as yours, but it'll be close. Okay. So what you guys have already done is the journal entries. Okay, so see the journal entries here. Okay, what you want to do is the T accounts right next to the journal entries. Okay, so the idea behind this is, here you have a debit to cash, a credit to common stock, all right? So what you'll do is you'll come over just to the right of these journal entries and start to create your T accounts, okay? And just do, merge those two cells, write in cash, and then debit cash for 50,000. And then you need capital stock. So go over right next to it and do a T account for capital stock, which this one, T account is down here somewhere. Right here. Okay, so but yours, it's fine, you can have it up there up at the top, but you'll notice that was a credit, so you need to put it over on the right side of the T account. So this is just, it's a little bit tedious, but it's not hard, right? So like here we have the rent deposit, it's a debit balance, so you'd create a T account that says rent deposit and then debit it $2,500, okay? And then rent expense, and just make a T account for rent expense and debit that for 2,500. And seeing what you can do is, if you'll reference, if you go equal sign and then click on this cash over here, it'll reference that. And if you go equal sign and reference this debit here, then it ties everything together, okay? And you'll notice here we have a credit to cash because we were paying out cash, and so we need to put that on the right side of the T account. And you just go through and do that for every one of these accounts, right? So if it's cash, you continue to put it in the cash T account, but if it's something new like notes payable, then you create a new T account for notes payable, okay? And then when you get through all of them, including the adjusting entries, then what you're going to do is sum up, okay? Sum up the debits and then subtract all of the credits, okay? Because you know that cash is going to have a normal debit balance, okay? Inventory is an asset, so it's also going to have a normal debit balance. You can see these guys didn't sell novelties, so they don't have anything for that. So you wouldn't even have a T account if you didn't do novelties. But like, let's see here, accounts payable, that's a liability, so it has a normal credit balance. So you'll sum the credits and subtract the debits, okay? And that's how you get your normal balances for these accounts. So essentially you'll have all these T accounts, a whole bunch of T accounts. It's a pain, I'm sorry, but it really does help you learn how this all works, okay? And then once you have that, then you'll do your trial balance, okay? And your trial balance will have those same accounts from all your T accounts. So you'll reference cash, so reference the T account up there, equal sign, then go up and click on that. And then the amount is the balance of that account. Do you see that? And it's a debit balance. So it's debited in the trial balance. So see, all of these assets are debit balances. Accumulated depreciation, that's a contra asset, so it's a credit balance. Franchise, these people obviously had a franchise. You may not have a franchise. But franchise is an asset, so it's debited. And then you have liabilities that are credited. Retained earnings will be zero because you're just starting the business out, okay? Sales is a revenue account, right? Sales revenue, so that's a credit. And anyways, you'll have all of those. Then once you're done with that, okay, so again, that's just transferring from the T accounts down to the trial balance. Like That's not very hard, right? It just takes some time, okay? And then the last step is to go ahead and start to prepare the financial statements. So start with your income statement, list your sales, list your cost of goods sold, and then your gross profit or your gross margin, okay? You know, it doesn't necessarily have to look like this. You can just do sales less cost of goods sold gives you gross profit, and then list all of your expenses, and that'll give you, you know, your revenue minus your expenses gives you net income. Then your statement of retained earnings, you start with a beginning zero balance because you just started, okay? Then you add in your net income from the income statement. You subtract off dividends. There are no dividends. You didn't pay dividends this month. And then you get your ending retained earnings, okay? Then go on to your balance sheet. You'll record all of your assets first, okay? That'll give you your total current assets. And then you do non-current assets, which are like fixed assets, so equipment, buildings, stuff like that. Well, there's no building here because you're renting, but anyway, there's office equipment, store equipment, and then that gives you your net equipment, your franchise. If you have that, that's a fixed asset, and then total assets. Then go through and list all of your liabilities, okay? And you don't have to, you can indent these if you want, or you can just put them all in a row. That's fine. Remember, they're not debits and credits at this point. They're just subtotals and totals. Okay, but you list all your liabilities, your current liabilities, and then your long-term liabilities. Your retained earnings comes from your statement of retained earnings. Common stock came from the trial balance. And then you have your total assets equals your total liabilities and stockholders' equity. That's the goal, is to get it balanced. Okay. So that's kind of the overview of from journal entries to T accounts to adjusted trial balance to financial statements. So don't hesitate to shoot me an email if you have any questions, and thank you for watching.